This morning, Canada announced a major reduction in crude oil flows to the United States, shaking the foundation of North American energy security. This isn't a technical glitch. It's a deliberate policy shift with immediate consequences for millions of Americans. For decades, Canadian crude has been the lifeblood of U.S. refineries, especially in the Midwest. That reliability is now in question, and the era of predictable energy partnership appears to be over. Energy traders are scrambling, politicians are demanding answers, and citizens are bracing for higher costs. North American energy independence, long a U.S. priority, is suddenly at risk. Canada's move exposes a vulnerability few policymakers anticipated. The flow of oil is not just business, it's trust. Today, that trust has been fractured. The Trudeau government's decision signals a bold new direction, prioritizing Canadian interests and challenging the status quo. This special report will break down what happened, why, and what it means for you. We'll examine the pipelines affected, hear from both sides, and explore the uncertain path ahead for this critical alliance. The energy landscape of our continent has been redrawn in a matter of hours. The implications are only beginning to unfold. Ottawa's action targets the Enbridge Mainline, North America's largest pipeline network, and the Keystone Pipeline, both crucial for U.S. refineries. By slashing U.S.-bound shipments, Canada has effectively turned down the main faucet. This isn't a minor adjustment, it's a major reduction that will be felt immediately. The Keystone system, quietly delivering over 500,000 barrels a day, is now restricted, disrupting the U.S. oil pricing and distribution network. Smaller lines like Trans Mountain are also part of this pivot, with incentives pushing Canadian oil toward Asian markets instead of the U.S. Canada is no longer content as a captive supplier, it's building new paths to new markets. For Americans, these pipelines aren't just names, they deliver the fuel that powers daily life. Refineries in the Midwest are designed for Canadian heavy crude and can't easily switch to other types. This disruption is a direct blow to America's industrial heartland. The circulatory system of our economy has been rerouted. The impact will be swift and widespread. The U.S. must now adapt to a new energy reality. Why did Canada make this move? Ottawa calls it strategic sovereignty, a bid to end decades of selling oil at a discount to the U.S. The new policy leverages the expanded Trans Mountain pipeline, opening access to Asian markets and higher prices. Canadian officials cite years of U.S. political uncertainty, especially the Keystone XL saga, as proof the U.S. is an unreliable partner. This is about taking control of Canada's economic destiny and maximizing national revenue. Domestically, the government frames it as a bold step for economic security and national pride. Canada is recasting itself as an independent energy power, not a junior partner. The bet, economic and political gains at home, will outweigh any fallout with Washington. The world is watching to see if it pays off. The U.S. now faces a stark reality. Its top oil supplier is no longer a guaranteed partner. This disruption forces America to seek alternative sources, possibly from less stable countries or the open market, reintroducing risks the U.S. hoped to avoid. Midwest refineries, built for Canadian heavy crude, face higher costs and logistical headaches. Analysts predict fuel prices in the upper Midwest will spike within weeks, straining household budgets and slowing economic growth. Canada's move shifts the power dynamic, giving Ottawa new leverage in future negotiations. The U.S. is now reacting, not leading, in this critical relationship. The event exposes the fragility of specialized supply chains built on perpetual cooperation. Investments and infrastructure assumed Canadian crude would always flow south. That assumption is gone, forcing a costly re-evaluation of U.S. energy strategy. The shock is a painful lesson in the risks of over-reliance, even on close allies. America's energy security is under real pressure. The balance of power in North America has shifted. The US must adapt quickly or face lasting consequences. On Capitol Hill, the response is swift. Deep concern and disappointment from the White House. Energy Secretary Granholm says urgent talks are underway to mitigate the impact on American consumers. Privately, Washington feels blindsided and frustrated. Ottawa, meanwhile, stands firm, calling the policy a forward-looking strategy for Canadian prosperity. Canada's Natural Resources Minister insists the move is about getting the best price for Canadian resources, not ending the US partnership. Energy analysts call this a paradigm shift. Canada is de-risking by diversifying away from the US. The US has lost its privileged status as the buyer of first resort. Industry leaders warn of imminent supply disruptions and major cost increases. Midwest refiners, built for Canadian crude, face a fundamental threat to their operations. The pressure is mounting for Washington to respond decisively. Both countries are entering uncharted territory. The stakes for businesses and families are high. The search for solutions is urgent. US-Canada energy ties run deep, dating back over a century. Post-Wabi Wound, the partnership blossomed, with pipelines like the Enbridge Main Line cementing a seamless continental energy system. For decades, both nations benefited. The US got secure oil, Canada got a stable market. NAFTA and USMCA further integrated the two economies. This history of cooperation makes Canada's move so shocking, a break from a century of mutual benefit. The assumption of perpetual partnership is gone. Canada now looks outward, not just south. An era of unparalleled energy synergy may be ending. With Canadian pipelines no longer reliable, the US must scramble for alternatives. Options include more imports from Mexico, Colombia, or even Venezuela, none as efficient or stable as Canada. Tanker transport is slower and riskier than pipelines. The US may try to boost domestic pipeline flows, but most available crude is lighter and requires costly refinery adjustments. Rail is a stopgap, not a solution. This crisis could reignite debates over new pipelines and refinery upgrades, pushing for greater US energy independence. For Canada, success depends on securing long-term Asian contracts. Competing with Saudi Arabia and Russia won't be easy. Both countries face high stakes and uncertain futures. The energy map of North America is being redrawn. Canada's move has sent shockwaves through global oil markets, spiking price volatility. US benchmark prices have surged on fears of domestic shortages, while Brent crude rises as America competes for global barrels. OPEC nations benefit from the turmoil, but Asian importers see opportunity in Canada's pivot. Countries like China and India may rush to secure Canadian oil, reshaping global trade flows. For Saudi Arabia and Russia, Canada's entry into Asia is a long-term threat to their market share. The global energy balance is shifting. US foreign policy may have to adjust, with less leverage for sanctions and more dependence on global suppliers. Energy independence is slipping away. The ripples from Canada's decision are global. The world is watching and recalibrating. The stakes have never been higher. The US-Canada energy partnership has entered a new, uncertain phase. Policymakers must urgently negotiate with Ottawa and rethink America's energy resilience. For Canada, the challenge is to secure new markets and manage fallout with its largest trading partner. The outcome will define both nations' economic futures. Citizens must stay informed. Energy policy now affects everything from gas prices to global power. The story of North American energy is no longer predictable. It's a fast-moving, high-stakes drama. Stay engaged, the next chapter is just beginning.